Hi there, good afternoon. You're watching Closing Trades on ET Now. I am Snehi Shah and I'm here to take you through the last leg of the trading day. We've got some time left and the Nifty continues to be as range bound as ever. We're still shy of that 24,600 mark for now. Pardon me. We've managed to touch that mark. 24,620 thereabouts is where we were at, and we've slipped about 25 to 30 points from there. But this is absolutely the range where we've been today. Tight range and absolutely flat on the Nifty. More or less 50 points range is what we've seen. Sensex too absolutely flat. It's the broader end of the market that's painting a rosier picture, because you've got the Nifty Midcap that's up about 0.5% on the back of some very stellar earnings coming in from the broader end of the market. You've got Nifty Small Cap Index also that's higher by about 0.1%. So flat with a hint of a positive bias on the Small Cap Index too. Taking you through what the sectoral gainers and losers look like. First, on the losing end, you've got Nifty PSU banks that continue to be under pressure. You've got Bank of India, Canara Bank, SBI that are some of your top losers from the Nifty PSU banking index. This followed by cuts in oil and gas, Nifty Bank, FMCG, Defense, Pharma, and you've got Nifty Energy that's absolutely flat. On the flip side, there's a very good move coming in on Nifty Realty today. Some names like Brigade are doing wonderfully well, 1.5% uptick over there on the index, and a good 4 to 5% jump coming in on Brigade as we speak. Nifty IT following closely next, about 0.5% uptick coming in over there. Then you've got some nominal gains in Nifty Metal, Finance and Media, and Autos also higher by about 0.2. So that's the kind of move that we're seeing on the market right now. On an index level, taking you through what the broader end of the market is doing, the Nifty 500 also absolutely even Steven. There's about 260 stocks in the green and about 240 in the red. That's the kind of split that we're seeing from the Nifty 500 group of stocks. The biggest losers today are power financiers. You've got PFC and REC. Both are under immense pressure. Cuts between 6 to 8%. NLC India weak earnings 6% lower, as was the case with Inox Wind as well. Afcons is under pressure. You've got Lupin, HPL Engineering, Ola. Most of these are earnings candidates that are under pressure. And on the flip side, Hitachi Energy India, strong set of numbers. BESS foray announced, multiple brokerage upgrades coming in. That stock is higher by about 11.25%. Paytm, Sirma, Sumitomo, all of these stocks are buzzing in trade. But while we're talking about stocks, let's take it across to my colleague Avi, who's joined us on the show with a list of all the stocks that are buzzing in trade as we speak. Avi.
So let's have a look at some of the stocks that are buzzing in trade, starting off from Ola Electric that have come out with its Q1 numbers. While the revenue is down by 45%, the EBITDA loss is in line with what the street was estimating, coming in at 165 crore rupees, while the loss is at 336 crore rupees, which is way below the street estimate of around 384 crore rupees of loss. Talking about the market share of Ola, it has improved from 5.1% in Q4 FY26 to around 8.4% in the quarter gone by. So that is a good news for Ola Electric. But the operating metrics is not something great that the company is operating with. Citi is still bearish on the stock and has given it a sell rating. The volume remains sluggish and the average selling price is also weak. The competition is escalating and rivals like Ather is performing better on all metrics. Legacy players are also doing quite well in the E2-wheeler segment. Up next is Afcons Infrastructure, which has pushed a weak set of numbers. The revenue is down 20%, the EBITDA is down around 40%, and the profit is down by about 77%. The margins have also contracted by more than 3%, and that is the reason the stock is seeing some selling pressure. Up next is ABFRL, which is the Aditya Birla's group division for fashion retail. Although the numbers are on a YOY basis up, but it seems to be that they are down by what the street was estimating, and that is why the stock is down and is seeing some selling pressure. The revenue has grown by 10%, the EBITDA is up 5.3%, the margins have contracted for the business by around 40 bips, and the loss is also widened, coming in at 215 crore rupees for ABFRL. So selling pressure seen in ABFRL as well. Up next is a strange case of Raymond Realty, wherein the numbers are quite strong for the quarter gone by, and yet the stock is down by around 10%. The revenue came in at 527 crore rupees, up 38%, EBITDA up 105%. The margins expanded quite a bit, around 3.77% margin expansion there, with net profit seeing a bit of tapering down at 13.43 crores. Our last pick would be Hitachi Energy, which is also known as Power India. Some very strong move the stock gives every time after its result, and this time it is up by around 10% on the back of very strong results. The revenue is a beat on the estimate, and so is the PAT. The EBITDA is in line with what the street was estimating. The margins were, however, a tad bit below than what the street was estimating, coming in at 14.6%. So those were the stocks that were buzzing in trade.
Okay, thank you so much for that, Avi. And that's with regard to some of the buzzers in trade. But Mithali here, with regard to Paytm, The stock is soaring after Bernstein has retained its outperform rating, now up 9.5% by the way, and raised its target price to 2200 from 1500. Bernstein has moved the UPI merchant discount rate or MDR from optionality into its base case, with benefits expected from FY28 itself. And Mitali here with the highlights from that note.
Right, so Paytm is in focus, and as it gains a sharp confidence coming in from Bernstein, as the brokerage has given a sharp spike in its target price for the stock. Now, Bernstein has retained its outperformed rating for the stock, but have raised their target price from the earlier of 1500 rupees to now 2200 rupees, citing an upside potential of nearly 53% from the last closing price. The key trigger is the UPI monetization, and Bernstein now moves the possibility of merchant discount rate, or what is called the MDR, on UPI from an optional upside scenario into now its base case starting FY 2028. Importantly, consumers are expected to continue using the UPI for free, with the charge largely to be borne by the merchants. Bernstein estimates that around 55% of UPI transaction value could be eligible for MDR in FY28, rising to 60% by FY 2030. And that matters because transactions above 2,000 rupees already account for more than two-thirds of the total UPI transaction in terms of values. So for Paytm, the impact could be meaningful, 3 to 4 basis points of incremental net payment margins, translating into around 22 billion rupees of additional EBITDA by FY 2030, as per the estimates cited by Bernstein. The broader growth story also remains quite strong, with GMV projected to rise from nearly 31 trillion rupees in FY27 to reaching to 56.6 trillion rupees by FY30, alongside improving contribution margins for the company. So overall, a very bullish stance coming in from Bernstein, and hence we can see that the stock has been in focus.
Okay, Mitali, thanks for taking us through that. So yes, a good note coming in from the house of Bernstein, a target price hike coming in on Paytm. They're now factoring in MDR as their base case, and they say that the benefits will start trickling in from FY28 for Paytm. On the back of that note, that stock is up 9.25%. We'll get a view on Paytm on the charts. So before that, Kunal has also joined us in the show. Kunal, hi, good afternoon. Give us your reading on the tight range that we've seen in the market today. 50, 60 points here and there, maybe not even that much. That's the kind of flattish move that we've seen. With the Nifty expiry at play tomorrow, what do you think the levels could look like?
Yeah, it's a good day for the markets. Good day because we are still range bound for the index. We are trying to consolidate at slightly higher levels, and it's good that the markets are holding on to that 24,500 mark. Of course, with all the adjustments last week towards the cash. So I think in that sense, it's been a decent market. Today, I think the market is more towards the breadth because you're seeing majority of the stocks which have been underperformers in the previous legs, like the defense, etc. I think these stocks are trying to make a comeback for themselves. So that I think is a positive for the overall market texture. And this also indicates that I think we are moving towards a phase where the markets are slowly and steadily going towards the sector rotation more. So I think that's a positive for the index overall. There are many of the stocks which have completed a mean retracement for themselves in the last 3-4 weeks. And that I think could be another opportunity in the capital market space. For example, BSE, that stock has completed a classic 20-25% mean reversion from its previous highs of 4,400 plus. So that I think could be a good space to look out for. So I think it's a space which the markets are going towards more often the sector rotation. And till the time we're holding on to that 24,500 levels on the index broadly as a support, I would expect that the trend for the index largely remains to be on the positive side.
Okay.
And Kunal, sectors at this point of time, if there is a specific view, what are you bullish on?
So financials, of course, are doing very well. The entire NBFC stroke HFC names, I think these stocks are doing fairly well for themselves. So I think the likes of Shriram Finance, Bajaj Finance making a good comeback. I was looking at the charts for L&T Finance, AB Capital, M&M Finance, etc. I think these stocks largely as an overall basket is something which I believe could be looked at even at current levels. The defense sector, I think that's another pocket which I would believe could probably be on the spring on the upside. You might probably expect a breakout coming pretty quickly for the likes of Bharat Dynamics, Mazagon Dock, and remember these two, even Bharat Electronics to a larger extent have been underperformers in the previous leg. So that's one pocket which I would look at. Capital market theme, that's another sector which I believe could be a decent bet given the risk reward. MCX, BAC, look at Angel One, Motilal Oswal Financial Services, etc. These stocks have gone through a decent correction the last 1.5 to 2.5 odd months. So I think the risk reward starts to look attractive.
And stock specific, you did share some names with us from the financials pack, but other than that, from the broader market, what's looking good?
So two buy calls, I would suggest Oberoi Realty is one of the stocks which again has gone through a 10% correction from a level of 1950 approximately. It's come back towards 1700, 1750 plus mark. So a decent 10% correction for the stock price looks attractive because it's taking support at the 50-day moving average. So I would suggest a buy on Oberoi Realty at the current levels. Would look out for almost 1840 as a target. Stop loss to be kept at 1760. The second would be a buy on Info Edge or NOC as the NSE code is. That's a classical chart. I think last month when the stock had given a 10% up move, moving up towards 1140 mark, it's moved up another 10% higher from those levels. But the manner in which the stock has climbed up another 10% from the previous breakout points, I think indicates that we are looking at a trend in the making for Info Edge. So that's also a buy. Targets of 1340, stop us at 1240.
I want to add a couple of names to that list, Kunal. A Teamlease, a Quest. That entire pack has done very well. What among these three should one bet on?
So Info Edge is of course something which you can bet on. Quest is the other stock which I believe should be looked at because this is another name which is very high beta. It's come out of almost like a 60% or a 70% correction from the 2024 highs. I think at 320 thereabouts, I would suggest that that's a stock which looks attractive. The only catch over here is that these stocks are very high beta. So you'll have to have a lower position size, a higher time frame. You'll have to do that adjustment.
Okay, understood. That's a take coming in on that space, Info Edge, Quests and Teamlease. But on that note, time to slip into a very short break. We'll keep the discussion going in terms of which stocks are buzzing, give you a list of some stocks that Kunal's also liking on the technicals. On the other side, stay tuned and we'll be right back.
Thanks for staying with us. In fact, we're joined by Nilesh Shetty of Quantum Advisor joining us this afternoon. Nilesh, hi, good having you. Let me first start off by getting your take on IT because the last time we spoke, you were bullish with regard to IT. You believed that it was oversold and the selling was overdone. We've seen a 20% upside now. What next? How much of the easy money is made? How much yet to go?
No, I mean, we continue to hold on to our positions. I mean, given the fall, the rally has been sort of not material. I think if you look at the Indian equity basket, perhaps that is one of the few places where valuations look extremely comfortable. Again, it's early days. I mean, there's no denying there'll be a disruption because of AI. But at least our thesis is a lot of that a lot of the Indian IT services companies will adapt and capture some of the opportunities that will come because of AI. So we continue to hold on to that position. Like I said, it has rebounded in the month of July. And there is still a long way to go given the scale of correction that has happened there.
Okay, Nilesh, hi, this is Snehi here and good to be speaking with you. What would the house call be on financials within that basket? What are some sub-themes that you're liking the most?
Yeah, so our largest weight remains in financials, but over the last sort of 2 years, it is increasingly moved towards the asset side of the household balance sheet, not the liability side. So we've added insurance names there, both on the life and general insurance side. We continue to hold an asset management company there. Private banks, we're slightly worried about sort of governance in some of the larger banks, where we have become a bit more cautious. But apart from that, our largest weight remains in financials, and especially the insurance basket looks very, very attractive relative to their own long-term history and valuations and where they are trading today.
And Nilesh, just therefore trying to get a sense, what is it that you're finding interesting post the Q1 numbers? Anything changes in terms of a view?
Yeah, I mean, not materially because we tend to have a slightly longer term view when we look to allocate. There are sectors which are getting more interesting, but not deep value because we run a value strategy. Consumer staples have meaningfully corrected over the last 5 years, but still not enough for us to justify adding them to the portfolio. But that's a space we are watching closely. There are some consumer discretionary names which look interesting, but not, again, attractive enough at the moment. But again, we continue to wait patiently. If they come to our valuation zone, we will be happy to add them to the portfolio.
What exactly are you adding there for, Nilesh?
So it's been a mix of, like I said, an insurance company, a couple of logistics companies. Because of the tariff issue, we saw a correction there, and we added them to the portfolio. There is a real estate company that we added first time in the last sort of 20 years. We added a real estate company where we felt governance was reasonable. So I mean, it's been a disparate set of companies, bottom up, which have come to the portfolio.
So, Nilesh, I just want to prod on that realty point that you've been making a little bit more. You know, you've finally come into the realty space after a very long time, like you were mentioning. What's the reason? What's the outlook on the sector? And would you perhaps be adding more names from this sector, given that it seems like there is another cycle in store for real estate?
Yeah, I mean, we've always been very, very cautious in that space because governance is not the best, given how real estate transactions happen in India. And given the promoter's penchant to take money out from the business, we've always sort of been very, very careful. There are probably two names that we would look at investing in. And one of those names actually came within the zone where we thought valuations were discounting sort of liquidation value in that business. So we added that to the portfolio. So there is a long-term macro theme in real estate, no doubt. But to get quality companies at reasonable valuations has not been that easy for us. Fortunately, 3 months ago, we got a company. But again, we don't have a doubt on the fact that real estate will grow in India. It is just the quality of managements that you want to invest in is not that easy.
And Nilesh, I wonder what's the take like on auto, because that was a sector which you were more, or rather trimming exposure to a couple of months ago. Give us the thesis on how this has played out versus what you were penciling in, and what's your expectation on auto going forward?
Yeah, so we had a very large overweight in auto 2 years ago. Since then, the companies have actually done quite well. And as you pointed out, we've been trimming, including the last quarter, we've trimmed our holdings there. We continue to hold a position which is probably half of what we did 2 years ago. It's not, I mean, given the upside that has happened after the GST cut, there will be some moderation that will kick in. But valuations right now are sort of at the upper end of where we would like to invest in these companies. So we continue to trim and wait patiently. If they were to correct, we will happily add them to the portfolio. Apart from that, right now is our view is it's expensive, that entire bucket.
Nilesh, is the same view, is that the view that you carry for metals as well? Because I understand you've been trimming when it comes to metals and commodities as well.
That's correct. The entire commodity basket actually has benefited over the last 2 years. So commodity companies you want to buy when it's a very stressful time for them. You want to add them at probably one-time price to book or below, and then you want to exit when commodity prices move higher. Otherwise, they tend to end up being value traps. Where optically it looks that valuations are attractive based on earnings, because you're at the upcycle of commodity. So at least our view is you are slightly on the upper side of the commodity upcycle, and valuations are sort of at the upper end of where you would want them to be. And so we've actually exited most of our commodity holdings. We have very negligible holding right now in a steel company, and we wait patiently for them to come to our levels.
And Nilesh, I wonder therefore, what is it that you're adding? Because if you're trimming large auto exposure and some metal exposure, then of course IT can't be the only thing which is looking like a hold at this point of time. I know you suggested bottom-up stories, but is there a theme that perhaps that you're looking at?
Not theme, but like I said, we've added an insurance company, we added a real estate company, and we added a couple of logistics companies to the portfolio. So there's no one broad theme, but within sort of sectors, specific pockets became interesting for us, which we added to the portfolio.
Or how are you looking at logistics as a theme to play?
Yeah, in India, logistics has always been a very, very attractive space, but unfortunately, they make very low ROEs.
Yes.
It's not. It's a very heavy capex intensive business. The existing players who have already made large investments and are already sitting on land banks which they can monetize, we tend to prefer that. And one of these companies actually came within a buy limit during the tariff issue, actually in the first wave of tariff, and then we added it to the portfolio where we felt valuations were attractive. And once the DFC sort of at least connects with the JNPT port, you will have an uptick in volume for that player.
Okay. And Nilesh, just wanted your view on some very niche spaces like precision engineering as a sector has been doing well of late. You've got some select specialty chemicals that are doing well. Have you been looking at these sectors? Have you been adding any names from these spaces?
Yeah, again, in a value strategy, unfortunately, they don't appear because their valuations are at the upper end. I know some of these precision engineering companies are based on sort of second order derivatives of the defense story. But again, they traded extremely high valuations. Specialty chemicals space did correct over the last sort of couple of years as sort of inventory supply got adjusted, but not attractive enough. Again, in that space, we are slightly wary because in the chemical space, we are still not extremely confident of the management quality and the governance norms in these companies. And we have very limited view sitting here on what is happening in China and when the capacity there comes online, which tends to have a large impact on global pricing. So we've actually had no allocation to both of these buckets.
And last off, just trying to get a sense, Nilesh, is it at all time for private sector banks, the larger ones, to be looked at afresh, just given the kind of valuation derating they've had and the kind of credit growth that there is, or would margins really bother you?
No, valuations have been attractive in the last 3 years, actually. So we've had very large allocation there. We have 5 banks in the portfolio. But for some reason, the market currently doesn't look at them favorably. And again, the margins are sort of near-term issue. I really don't think it bothers for long. It's a big matter for long-term investors. But for some reason, they are out of favor at the moment. And I don't know when the market suddenly looks at them, but whenever they do, the re-rating can be quite sharp.
Okay, understood. We're going to be watching out for all of these spaces. Nilesh, wonderful to be chatting with you today. Thank you so much for your time. On that note, viewers, time to slip into a very short break on this edition of Closing Trades. Lots more to cover on the other side in terms of sectors, some of the top buzzers of the day, some trends that we're spotting. So stay tuned and we'll be right back with all of that and much more. Back with Closing Trades and good to have you back with us. Let's take it across to Meryl, who's here with a list of all the stocks that are abuzz right now, because as flat as the markets are at an index level, the broader end, especially the mid-cap end of the market, has been abuzz. Meryl is joining us with a list of some stocks that are keeping that momentum going. Meryl.
Right, so these are all of the stocks that we're seeing in focus today on the back of their first quarter results. Starting first with Entero Healthcare, the company reported its result over the weekend, and we're seeing revenues up about 40% on a year-on-year basis. EBITDA has also gone up, almost doubling in the first quarter compared to the last year's first quarter. Margin as well has seen a bit of an expansion from 3.5% earlier to now reaching 5%, beating street estimates. Profit as well has gone up by 40%. So overall, the company seems to have beaten street estimates on all fronts, which is why we're seeing this surge in today's share price as well. Akums Drugs has also reported quite a strong set of first quarter numbers, where revenue has gone up by 15% and profit, however, has gone up by almost 60%. So a lot of strong operating and financial leverage having played out on that front. The company's seen its margins as well expand up to 15% from the earlier 12.6%. Moving on, we've got Patel Engineering also in focus, where the company's posted a revenue increase of about 4% on a year-on-year basis. EBITDA has gone out by about 10% on a year-on-year basis, and profitability has surged up by 22% year-on-year. So a lot of good leverage playing in on that front as well. While Talbros Autos has also seen a better performance. Now, while the company has reported its highest ever quarterly revenue growth in the top line sense, the bottom line and the profitability for the company has come under slight bit of pressure given the West Asia crisis and the inflationary effects that it's seen on its raw material pricing. Margins have come out slightly flattish for the company at 16.2 versus 15% in the previous year's corresponding quarter. So these are some stocks that we've seen buzzing in trade today on the back of their first quarter performance.
Okay, thank you so much for that, Meryl. Let me bring on board Richard Jain of Motilal Oswal Financial Services to give us his perspective of how he's looking at markets. Richard, on the index itself, what's the call? What's the view?
Yeah, hi, very good afternoon, Harsh.
Good afternoon.
Well, overall, on the index front, we have been witnessing a consolidation phase since last 4 or 5 trading sessions. But the good thing is that the index recently gave a breakout above the 24,400, 500 resistance. and this entire consolidation is happening above that level. So which indicates that this previous resistance could now act as a support. The 20 DEMA for Nifty is still around 24,350 kind of levels. So I think here on, no, still the index is also above that 20 DEMA. So the downside seems to be limited. Once we come out of this consolidation, then we could see the next leg of positive momentum towards 25,000 level. But yes, one need to have some patience. So if one is looking for a very day trading or next 1 or 2 trading sessions, then we could see a continuation of a sideways trend. But from a positional perspective, the risk reward ratio seems favorable, considering one can keep stop loss below 24,350, just below that 20 DMA, and no wait for an up move towards 25,000, 25,200. But I think that view should play out positionally rather than in a day or two.
Okay, that's the view on the markets. Ruchit, hi. Before we get to your stock recommendations, just wanted your view on the entire power finance space. We've seen a sharp cut coming in on both REC and PFC. Both those stocks are lower by 6 to 8% today. Attractive price point to make a fresh entry?
Hi, very good afternoon. Not really, because no, we already seen a decent amount of underperformance in this stock, be it REC or PFC. If you look at last 3 or 4 months when the broader markets have done well, we have not seen any kind of outperformance or participation on the positive side from them. And today, even if PFC has broken its support, the selling has been supported by high volumes. And whenever we see selling supported by higher volumes, then that underperformance could last for a while. So I don't think that one should look to do any kind of bottom fishing over here in both PFC and REC.
What about IREDA? If I can add that to the list, would that at all look interesting, Ruchit?
Well, even that has been a relative underperformer, and we have not seen any kind of volume participation happening whenever there are in between pullback moves. So that 200 EMA around 134, 133 remains a crucial level, and until we see a breakout above that, largely the stock should consolidate with a bit negative bias.
And Ruchit, we've been speaking of Paytm also. So my question is slightly different to you. After this 10% surge that we've seen in Paytm today, should our viewers who hold the stock maybe sell part of it, sell that entire holding and book a profit, or are you still seeing further legroom for growth when it comes to Paytm stock price?
So frankly, we have added Paytm in one of our model portfolio which we run around 1570, and we are still holding the entire position. We have not done any kind of partial profit booking or entire profit booking. Charts are so strong. If you look on the weekly and the monthly charts, then whenever we see such kind of breakouts on the larger time frame chart, I think that outperformance could continue. So still good scope is there for the stock to rally further higher. So if anyone is holding the long position, then they should continue to ride this trend.
Very interesting. Okay, I'm going to also quickly try and pull out some other buzzers in trade, at least today. And you're seeing some good, strong action even on an info edge. Now, while we've taken Kunal's view on info edge, what's your view, Ruchit? Give us your take. Ruchit, info edge?
Yeah, so within the IT space, the stock has seen a high top, high bottom structure recently. So overall structure seems to be on the positive side for InfoEdge. But just because before the numbers, I think the stock has already seen a run-up move, so I won't advise taking a fresh position. Maybe it's reaction in a day after the numbers. One should watch out for that. If any existing long positions are there, then immediate support is around 1180, 1200. So one can keep stop loss below 1180 and hold their long positions.
Okay, that's the take coming in on InfoEdge. Rajit, how are you looking at the defense space? BEML is a stock that's doing really well today. Other than that, also you've got some buzzers from the defense pack today. How are you looking at stocks? How are you looking at any sub-themes within defense, like shipbuilding perhaps? Anything that you're liking?
So yes, overall structure seems to be positive for Nifty India Defense Index. Certain stocks like HL had recently given a breakout from its from its falling trend line recently during last week. Also, within the entire defense space, Midhani is another stock which we hold in our model portfolio, where the overall structure seems to be quite strong. So one can be selective in stocks which have been witnessing good volumes along with the price up moves. So these are a couple of names: HAL, Midhani, and BDL. I would add one where the risk reward ratio seems favorable because the stock has already gone through a decent time wise as well as price wise corrective phase. and the stock has formed a good support around 1230, 1240 kind of levels. So overall outlook for the sector is positive, but selective names where good volumes are seen, I think one should take interest in those names.
And what do you make of the move on Bharat Forge last off? Just that 8% downtake post the numbers. Opportunity at all, Ruchit, in your opinion?
Yes, we have often seen that if the stock has given already a run up already before the numbers, then irrespective of the numbers, we many times we see profit booking, which leads to a correction in the stock. So I think we are looking similar kind of scenario for Bharat Forge as well. If you look at last 3 months, at the start of April, or at in the second week of April, the stock was trading around 1650. From 1650, the stock has already given a run up towards 2300 in last 3-4 months. So I think the price rally has already been there before the numbers. So now we are witnessing that pullback, and support is around 2000 levels where the weekly 20 EMA will come. So I won't be in a hurry to do bottom fishing over here. I won't advise that. Let the volatility settle down, maybe around 2000. If the stock tries to take a support, then one should review it again.
Okay, no bottom fishing recommended for Bharat Forge, as well as some of the power financiers that we were discussing with Ruchit. Ruchit, on that note, thank you so much for your time. Good to be speaking with you today. Thank you.
Thank
Viewers,
you.
time for a very short break on this edition of Closing Trades. Be right back with more on the other side.
Welcome back. And one of the big buzzers, and we spoke to Ruchit about that just a few minutes ago, is Bharat Forge on the back of the numbers. Very weak first quarter is what it's looking like. Pat has missed estimates by quite a bit. Margins have come under pressure. Company has also cut its margin guidance. Avi here with the highlights.
Out with its Q1 FY27 results, and the stock is seeing some massive selling pressure, the main reason for which is the management lowering its guidance range from a flat 25% for the Indian manufacturing business down in the range of 20 to 25% for the Indian manufacturing business, which will be more pronounced in the second half of the year. And with the recent restructuring in their EV business and the German forging business, they are guiding that the near term, in the medium term, the path to profitability remains a challenge for them, which is a big negative for the company, and that is the reason the stock is down by about 8%. Talking about the Europe manufacturing business, we can see that the EBITDA is down by 200 bips on a sequential basis, and for the US manufacturing business, the EBITDA is negative at minus 0.8% compared to a positive 6.1% for the same period last year. Although the revenue is in line with what the street was estimating, the margins have contracted for the company, and they've also recorded a 358 crore rupees of exceptional loss because of the restructuring provision that they've created for the German subsidiary. So all in all, a poor set of results for the company. The board has also approved, subject to shareholders' approval, a 2500 crore rupees of fundraise through the issue of equity shares. So a poor set of results from Bharat Forge with the EBITDA and PAT missing, a 358 crore rupees exceptional loss for the German subsidiary, and the path to profitability for their EV and German forging business seems a challenge for the company, and they've also lowered the guidance from 25% down to 20 to 25%.
Lots of factors at play, in fact, that's leading to a dent in the stock for Bharat Forge. Ravi, thanks for that. Ravi was highlighting the weakness in the numbers as well as the guidance stream coming in from the company, and that's why the stock is under pressure. But let's also take a look at some of the chart structures for Bharat Forge. In fact, before we do that, I also want to shift focus and quickly take you through what the rejig news is that we're looking at when it comes to Nifty. Nifty could see a rejig today, with Nuvama expecting BSE to replace Wipro under the current methodology. BSE could see inflows of around $741 million, equivalent to 6 days of average daily volumes, while Wipro could face outflows. And in the next Nifty Next 50, pardon me, Vedanta Aluminium, BHEL and Hitachi Energy could be included. Ashish is joining us with some of those expectations that Nuvama is penciling in.
Well, yes, Nuvama Alternative and Quantitative Research has come out with a report on expectations of likely inclusions and exit from Nifty indices in the September rejig, the announcement of which is likely over the next few days. Let's start with Nifty 50, and they're expecting BSE to be included in the index, which would entail an inflow of about $741 million US. On the flip side, they are expecting Wipro to be excluded out of the Nifty 50 index, which will imply an outflow of about 246 million US dollars. So those are the two big changes that they are expecting from the Nifty 50 index, where BSE is likely to replace Wipro from the Nifty 50 index. Let's also talk about a couple of other indices within the Nifty basket and the likely changes that we are expecting. In fact, they also say that TVS Motor could also replace if the methodology of calculating how Nifty 50 constituents are placed in the Nifty 50 index changes, and the announcement of that is likely to come today evening. Let's also talk about the next 50, Nifty Next 50 index, and we are expecting Vedanta Aluminium to be included with an inflow of about 143 million US dollars. BHEL, Wipro and Polycab are a couple of other likely inclusions in the Nifty Next 50 index with an outflow and inflow that is flashing for you on your screens. Meanwhile, Hitachi Energy and Vodafone Idea also are likely constituents to be added in the Nifty Next index. 75 million US dollars and 71 million US dollars of inflow is likely for both these counters. Let's also talk about the outflows then, and several stocks are likely to be excluded from the Nifty 50 Next index. It includes Indian Hotels, RBC, United Spirits, with an outflow anywhere between 78 to 124 million US dollars, and a couple of other counters which are likely to get excluded from the Nifty Next 50 index also include something like Shree Cement, Lodha and Mascot Dock, with an outflow anywhere between 35 to 70 million US dollars. So these are the 6 stocks which are likely to get excluded from the Nifty Next index. Meanwhile, let's also talk about Nifty 100 index then, and we have Vedanta Aluminium, BSE, Hitachi Energy, Idea, that's Vodafone Idea, Polycab and BHEL that are likely to get included. On the flip side, Shree Cement, REC, Lodha, Indian Hotels, United Spirits and Mascot Dock are likely to get excluded from the Nifty 100 index. So these are largely the changes that Nuvama is expecting at this point in time. If the methodology of calculation changes, perhaps there could be some changes over here, and the announcement of this change in methodology is likely to come later today.
Okay, thank you so much for that, Ashesha. Very curious to know, Kunal, and let me also bring on board Pashupati Advani. He is from Global Foray, of course, and Pashupati, great having you. But Kunal, just
Good
kind
afternoon.
of completing and rounding this up, give us a sense, BSE, Wipro, how do they look on charts?
Yeah, I think BSE starts to look now a little bit more attractive because of the 20% odd correction the stock has gone through in the last 2.5 odd months. I think from 4,400 levels towards 3,000, 350, where the stock formed a decent base, bouncing off from its long-term averages. The mean reversion sort of seems to be completed for BSE. Historically, what we've seen is that the stock, whenever it's gone through periods of corrections, which have lasted for more than 2 months or 3 months, the average correction for the stock has been around 20% to 30%. Broadly for the stock price. So which means that's why I was indicating that maybe the stock has entered into the territory where medium-term investors should start to look at BSE with a slight positive bias. And for Wipro, I would sense that I think there are better stocks available in the Nifty IT space as of now. I would still look at the more formidable large cap IT stocks, the likes of HCL, Tech, Infosys, TCS as preferred bets over Wipro.
Okay, that's the pecking order when it comes to some of those IT names that Kunal's flagging off. But Mr. Advani, hi, good afternoon, and thanks for waiting by. Good to be speaking with you. How are you looking at the markets right now? Last week, we've seen ups and downs coming in the market. It was the first week of the CAS adjustment coming into play as well. Today, we're as range-bound as ever. Give us a sense on how you're looking at the markets and where are we headed from here?
Well, I think, this balancing of the indices is obviously something that is good in the long term because, I particularly have been kind of soft on IT. I don't think that we've been able to perform. So the fact that Wipro is going to leave the index will probably lower the IT in it. And I think that's good because, indices have a way of kind of reacting to what the market wants. And obviously the market wants the Nifty 50 to go up. And therefore, the stocks that are pulling it down, they want to hold it. They want to get rid of those and substitute those for others that are jumping. So I guess it's a natural bias, which is actually happening. Again, I think it's been very, very quiet also because there's huge uncertainty, because of the Gulf War and, the on again, off again of the US government with Iran and, all the permutations and combinations. I believe Iran threw some drones at the UAE over the weekend. So that's also not such a great thing. But it's not escalating, but they just everyone's sort of doing their little bit to make sure that the war is still there in the background. And so obviously anything for that could hurt us, but we are so far insulated, and we so far have loaded up buying oil. And actually, what's happened is that I think all the countries that were short of oil have loaded up and put stuff away, and now they've gone back to buying gold, because gold seems to have moved up in about 10%, and not 10%, 5-6% in the last week or so. So that's all good.
Okay, appreciate that view coming in. Apologies, Mr. Advani. We'll have to slip into a time-bound commercial. We'll be right back on the other side of this very short break. Keep the conversation going with both Kunal as well as Mr. Advani. Stay tuned.
Welcome back, and thanks for being with us. Pashupati, coming straight back to you, trying to get a sense, therefore, how are you looking at IT? You were pessimistic, if I recall right, the last time we had spoken. Anything changes for you, or is there a certain segment within IT that you're liking? Sorry, please go ahead.
No, so I am still pessimistic, but IT seems to have caught something of the bottom and then moved up from the bottom in a lot of certainly the larger IT companies, and they've shown some strength. So they are trying to get their act together, and I think they will. And obviously, there's many a slip between the cup and the lip, and therefore you've got all these ideas which everyone thought AI is going to come and change everything and make everything go crazy. It's coming, but it's coming slowly, and it requires a different skill set, and some of it our IT companies are beginning to provide. So I think it's not going to be a sort of a dump, but I think it's going to be, I'm still not pessimistic on the sector.
Mr. Advani, that's your view on IT. And other than that, given the Q1 earnings and how the trends are playing out in the market right now, how would you best play consumption?
Well, you have to get something that is domestic, which does not have any import in it. And, so therefore people are going back to the FMCGs and back to the local FMCGs. And of course, oil companies, because oil is going up and they should also do better. So that's another sector that's doing well. I'm not so wild about the banks. HDFC Bank, which is a major part of the index, is down quite a lot from its highs. It's down, I think, 25%, if not more. And it seems to be having its own issues. The others seem to be hovering in there, but that's pulling the bank index down. Who knows? I mean, I think we are having a sort of revisiting, realignment of the whole index. And I think that's happening. So people are actually making positional changes.
Me?
And sorry, I'll come straight back to IT. Pashupati, how are you seeing the environment evolve, right? Especially with regard to AI. I'm trying to get a sense as to whether certain product companies in India, investable, are catching your eye, probably getting beaten down, maybe unnecessarily, or any trend that you're spotting where you can play AI slightly better, where there's some value capture left?
Well, the reality is that the Western world seems to have written off India for AI. I personally believe that we have got some niche markets in there where we can come in, but they have to be proven. And so far, whenever any of the IT companies have given any guidance, they've not actually been too sort of what I would say pakka about that this is going to happen and this is not going to happen. It's beginning to turn, so maybe next quarter we'll see better guidance. But at the moment, we're seeing companies all over the place, and they're not really able to step up. And they're trying to figure out what they can do in IT to make themselves relevant. And I haven't yet seen a business model from any of our big companies or small companies that says, here's the solution, this is how we're going to play the AI market as an IT company, as an Indian IT company. So I haven't seen it yet. And if you have, please share it with me.
So you'd stay away. You stayed completely away for the moment.
Yeah, for the
And probably you'd only play through the product companies in the US, right? Pashupati, is that the right way to kind of think of how you're thinking of AI and this entire
Well,
entire theme
even
that's
those
going on.
are also having their own issues, because it looks like Chinese AI is 1/10 the cost of US AI, and therefore people are looking at the spreadsheets there, and we've had these huge drops in some of the big companies. But the reality is, data centers are going to be needed. We are needing more computing power. We're going to need power, so actual electrical power to run those data centers. So I think all these things, that's where the values are, and that's where we're going to have to invest. So, electrical power is a simple thing that, you need it. We're short. Prices have to go up, except for the fact that the government controls the prices. Everything else is good for it. And, so I think that's a sector that also one should be looking at properly.
So then power ancillaries and the like, is that probably the best way to play this theme?
Yeah, absolutely.
Okay. And would you at all
Power
venture...
ancillaries,
sorry, please go ahead. Please go
telecom
ahead.
maybe. Yeah, maybe telecom also, because we're still needing data, we're still needing information. So telecom ancillaries, these are all the plays. They're still the hot plays, and I think people will continue. And these are, I would say, necessities. We can't do without them. So I mean, that's what it is.
Look at power transmission and power exchanges, because we're speaking to a couple of renewable energy companies, and they were suggesting the gaps are on the power transmission side of things. So transmission exchanges, what's the view there?
Well, exchanges were there to stay. I think everyone is using their own power, so they're not pushing that much out on the exchange. But I think that that exchange business for power is definitely a business to be in. Power transmission also, because it's being produced in different places from where it's being used. So as long as that continues, I think that's something that will be required. So yes, that's a sector also that I'm quite comfortable being in for the long term.
And Mr. Advani, before this, you were talking about some sectors that have become absolutely essential, and they're the new age themes. Speaking of which, how are you looking at certain themes like beauty and personal care, some of the platform companies, some quick commerce, food delivery companies? How are you looking at all of these names? Do you believe the valuations are perhaps maybe too high right now, or do you believe that these companies have such a growth leg room ahead, or the run up ahead, that valuations could perhaps take the backseat right now?
So what's happening is that as we get wealthier, people are going to start using more and more of these companies. I think what's happening now, we're at an inflection point where people are actually beginning to tighten their belts a little bit. So they are actually not buying, 300 rupee coffee cups at Starbucks, or they are trying to use less makeup. I know you put Nike on the screen, but that, something like that. But the reality is that I think these habits are here to stay. They're very difficult to change, and certainly the next generation, my kids and all the others, love this kind of thing. I mean, certainly with people staying in smaller units, like 1 and 2 and 3 people, they are quite happy to have Swiggy. They're quite happy to have Nykaa. They don't want to go to shops. They would rather have it delivered to them at home, and that's a whole change of mindset. I mean, I think in our parents' generation, they wanted to go and feel the tomatoes. In this generation, we live with some tomatoes coming home. The next generation, they want it only to come home. They don't want to go to the supermarket. They just want delivery. They want it easy. So I think that this is what it is. But whether the trend changes for the better or for the most, right now it looks like the trend is there with the Zwiggys and the Eternals and Zomato are there, so they're here to stay.
How else would you play consumption? Just give us a sense, Pashupati. How would you look at the FMCG players and say that this 5-6 years of no moves on an HUL presents an opportunity, a compelling one?
Well, I think there are new players coming in. I believe that, Reliance has taken a pretty aggressive stand in the FMCG space. And where Reliance's numbers show in that space is somewhere in the big block that's Reliance Industries. So I believe they're giving HUL a bit of a run for its money and coming up with Indian competitive products, Make in India type products that are fighting with HUL products. They're also pushing in the distribution. So, HUL is a separate issue. But I think, you see the sort of Indian FMCG like a Haldiram or something. Those are, people are still buying. Again, that's habit. Is Haldiram snacks healthy? Who knows? Who cares? But the reality is that people are buying them. So as long as that trend continues, I think that will be good.
Okay, and also just trying to, trying to understand how you're looking at consumption trends. The premium end is obviously doing very well for itself, likely to continue in your opinion, and therefore auto, there's a watch distributor, Ethos. There are, of course, there's Titan and the like, which also does watches, eyewear and the like. That end will continue to do better, you reckon?
Yeah, I think the premium end you can just forget about, because there is such a gap between people who are buying premium product and the rest of the market that it's really I think it's a price insensitive market almost. And the fact that people are moving a lot of cars, autos are actually at a lot of deliveries happening at the moment, and also premium autos, a lot of deliveries are happening at the moment. You mentioned other luxury brands like Ethos. People are looking out to spend money. And I've been watching some YouTubes on how to use credit cards to get points, which then translate into goods and holidays. So these are all the things that are happening in the market. But the reality is that India is changing. We are getting richer, and we're going to suddenly tip. Right now, we are just below the tipping point. But if we suddenly tip and the per capita income goes up, then suddenly consumption patterns will change, and India will become a very different place. And that's the way I think it's going. So.
Okay. Understood. Hold that thought, Mr. Advani. We're going to quickly shift gears because the Supreme Court may soon hear a review petition challenging its recent ruling on the notional income of homemakers in the motor accident claims tribunal cases. My colleague Anurag Shah is joining us with more details on this. Anurag, over to you.
Supreme Court is likely to hear review petition in notional income for homemakers case, and as per our sources, a review petition has been accepted by the top court, and the court is likely to hear the review petition soon. On 11th June, an order was passed by Supreme Court to fix the notional income for homemakers as 30,000 rupees per month, and in that connection only review petition has been filed because insurance industries is seeking a methodology to calculate the compensation amount, and insurance industry is also mentioning a previous ruling by court where in a similar case, in a similar type of a compensation case, a court award mentioned a wage amount of 2,500 rupees per month in year 2003. So review petition is seeking a methodology to calculate the compensation amount. Previously, most of the insurance companies, general insurance companies, has increased their provisions after the court order, and because insurance industry is expecting that their loss ratio may increase and overall compensation for motor third party cases, MACT order may increase after the Supreme Court order. So in this context only, review petition has been filed seeking a methodology for the compensation amount, and top court is likely to hear the review petition very soon.
Okay, Anurag, thanks for taking us through that. That's the latest update over there. And of course, we'll keep you abreast with the latest developments on that front. Mr. Advani, how are you looking at the insurance space? Because last week also, when there was this news coming in that motor insurance for 2- and 4-wheelers is now going to become compulsory for an extended period of time, you did have some general insurance companies that started to do well. And now my colleague Anurag was also highlighting some of the insurance developments. How are you looking at insurance?
Well, more cars, more two-wheelers, more insurance. I think, again, a trend of having a higher policy limit for home insurance is less. I mean, most people underinsure their homes. But I think that's also changing, and people are actually stepping up and giving bigger checks. I think if the government gave some incentive to insure your home, and allowing some deduction for health insurance, similar you have a deduction for home insurance, then that would be a huge industry and would be a huge plus for all the insurance companies. In the meantime, they're doing well. They've got money. They've got investments. The markets are doing okay. So, they're making money and they're all, look profitable. So I think it's an industry definitely to be in.
Mr. Pashupati, just on that note, are you preferring general and motor insurance perhaps over your traditional life insurance names?
Well, I'm actually a little surprised that LIC has got hammered down to where it has. It's always been the sort of bellwether insurance, but it's trended down a lot. So I think the answer is maybe to go into general insurance now rather than into life insurance. Though life insurance should also be picking up, but I think that people are buying cars. They're not taking out life insurance, but they're buying cars and they're buying two-wheelers. So I think and the fact that you do need some kind of compulsory insurance, I think that will remain. So I think that's good for both the industry. And as I said, as we get richer, more money will go into insurance, and I think that's good for the sector as a whole.
Okay, we'll take a bit of a breather, slip into a break, come back. Pashupati, Kunal, please be with us, and we'll address that last 20 odd minutes of trade. Of course, including the cash segment. We will address that on the other side. Stay with us. Welcome back, and the cash segment, of course, playing out in markets as we speak. You can see some of the moves. Let's pull out an SBI Life if we can, because saw a spike on that stock. It's cooled off, of course, from the highs. But you also saw a bit of a spike on an ICICI Bank. Some moves being made, of course, and we're tracking those moves. But in fact, SBI Life is again up 1.1 odd %. But Kunal, how's it looking, at least in trade today?
It's a little volatile. I think that Friday effect, which was there with the markets, were a little eased off. I would say that slight bit of volatility sort of comes back again. But again, I think we need to see and wait till 3:30 how the closing goes. But then I think I don't expect that we could probably swing by at 200 plus points what we did at the start. Maybe I think the tone for the swing in the markets or the indices specifically, I think is less than that at least. And I think if that happens also for a good part of this week, that also indicates that the markets are adjusting to this new reality.
Okay, that's the take coming in. And what's really standing out in the cash segment right now is some of the names from the QSR basket are doing really well. We've seen a sharp spike coming in on Sapphire Foods, 1.25% uptick over there. You've got Devyani International that's doing well in the cash right now. So good move coming over there as well. Mr. Advani, how are you looking at QSR as a space? It's been underperforming for the longest time. This time, however, for Restaurant Brands Asia, for Devyani, Westlife, we've seen a turnaround coming in, while Jubilant is still expected to be slightly under pressure because of that LPG impact. But do you believe that the turnaround for QSR is finally here, and is it here to stay?
Well, I certainly hope that it's here to stay, but I think that again, it is to do with the fact that are we becoming a richer country, and are we beginning to upgrade? I mean, one of the things that's happened in Mumbai, as you well know, is that the FSSAI has raided some 2,100 restaurants. So certainly they've pushed people from non-QSR to QSR. So I'm sure that's going to make a big difference. And I think that certainly we need to get cleaner food, and everybody seems to be happy about that happening. So having said that, I think that you've got an issue where people are seeing it and are going out. And previously maybe they'd go to the road to eat. Now they'll go to a QSR, and hopefully that trend continues. And as people get richer and richer, that'll be good for all these companies. And we are at that inflection point, I feel, that we could suddenly jump.
Okay, and what do you make of what's playing out in the cash in this entire slightly new mechanism of closing and cash? What do you make of that, Pashupati? I wonder what your view is.
I think the SEBI should write manuals and give them to all retail investors, because they seem to be losing their shirts in this. So I think that some protection has to come. I think they've turned some of the buttons off and made it a little slower, but I think that it's still extremely confusing, and also, unfortunately, given the spikes that we're still seeing, extremely manipulative, which is not good for the retail investor. And I think SEBI's job is to actually look at that and to try and protect the retail investors. So either you tell them don't trade, or you tell them that we're going to protect you from these crazy spikes. And I know that a lot of people got hit last week, and it seems to be still continuing because the spikes are still there.
Working on that manual?
Yeah, reading the manual.
Sounds like an opportunity.
Waiting for the manual to come so that I can read.
But speaking of spikes, you know, on the downward side, we've spoken about some stocks that are doing well in the cash segment. On the downward side, however, Aegis Vopak is lower by 2% in cash. You've got Acme Solar seeing a cut of 1%. Bharat Forge continues to reel under pressure, as is the case with the Zydus Wellness. Jindal Saw also now joining that list with a cut of 1%. Kunal, any of these names, how are they shaping up on the charts? Any view on something like an Acme Solar, perhaps? We've not spoken about that stock in some time now.
Yeah, I think, actually what has happened is many of the solar stocks, the last I had seen, I think I've gone through a decent correction or a time-wise pause in the last 2-3 months or so. I was looking at Acme Solar, Vikram Solar, etc. I think these stocks have gone through a decent correction or a sideways range. It's just that I would sense it's a lack of participation, lack of interest into this sector at large, and that's why I would sense that these prices would probably come back into a further correction going forward. So I'm not too much concerned over the major price-wise correction, but I think it's a time-wise pause which could probably hit a short-term trader into investing into these names.
Okay, just taking a look at where some of these names are settling as the cash market closes. 3% uptick on Titan today, looking good. One of the top Nifty gainers on the back of good earnings. Shriram Finance also joining that list from the Nifty, a 2% uptick over there too. Right now, as of now for the Nifty, we're absolutely flat, continue to be there, but we've also slipped slightly further away from the 24,600 mark. 24,583 is where we're at. Sensex continues to be flat, as is the case with the Nifty Bank and the Nifty Small Cap Index. However, that 0.5% uptick on the Nifty Midcap, that continues to stay, so that looks good. From the broader end, it's actually quite even Steven, but in fact now the favor is tilted towards the decline slightly. PFC, Bharat Forge, REC, NLC India, Inox Wind, cuts of 6 to 8.5% on all of these names, and these are some names that are causing pressure to the Nifty 500. But on the flip side, stellar earnings from Hitachi, a good Bernstein note coming in on Paytm, that stock up 10%. Syrma SGS, Sumitomo Chemical, BEML, Schneider Electric, Pine Labs, Allied Blenders, all of these are some stocks that are doing well from the broader end, and that is actually how the cash market is coming to an end right now, with the Nifty at 24,583. Kunal, quick thoughts on the kind of trading session that we've seen today. We've been absolutely range bound and lots of action expected tomorrow. Amphi data, that Amphi numbers will also be out, and just a quick view on how the trading session has been.
See, it's almost like 5 days the markets have grinded into this 200-point band. You know, we've been stuck over the last 5 days at 24,500 plus minus 100 points for the index, and it's getting a little bit more, I would say, tighter for the large cap stocks to show signs of any kind of a big breakout momentum. It's just that I think the real moves are actually happening across the underperforming sectors and the stocks which are beyond the Nifty 50 basket, and I think that's where a trader seems to be concentrating upon. Largely the Bank Nifty, I think, has been having a flip-flop because we've been stuck around this 58,000 mark for the Bank Nifty. There are days where you see the PSU banking stocks outperform, like what happened the previous week, and then there are days where you see the PSU banking stocks underperform. So it's like a flip-flop action which is going on across the major sectors. But then broadly, I would sense that we're just going through a patch of consolidation. Hopefully, I think we don't extend it beyond to a certain point where the participation drops down from the index levels per se. The positive part when you look at the index parameters is that the put call ratio, which was almost at 1.6, 1.57 start of the previous week or mid of the previous week, that's cooled off quite significantly from those elevated levels. So that probably indicates that the markets are now into a balanced mode or an equilibrium zone.
And this equilibrium that you're talking about, Kunal, it seems to be slightly visible in the market because given that this is the 6th session where the cash has come into play, you've got the Nifty that between 315 and 330 has spiked by only 0.1%. So quite stable over there also, right?
Yeah. So I think that's what I was saying, that the markets are now adjusting towards this new reality. Hopefully, I think we see that effect playing very less from a closing perspective. And I think if that happens, I think the entire notion of introducing cash as a system, I think finally gets achieved.
I want to quickly also quiz you, Pashupati, with regard to how you're looking at realty. You clearly said premiumization is playing out and playing out very well for India. I wonder if Realty as a pack, you expect that to continue to outperform because you've seen some very strong moves. Realty bottomed at maybe 650, 670 on the index. We're currently at 900.
Well, the reality, the reality of realty is that people are looking for triggers. As you said, premiumization is doing okay, but the next level is still chugging along. There seems to be a lot of redevelopment happening, certainly in Bombay, and that's kind of what we're seeing. So because there's such a lot of redevelopment, it's going to take the whole cycle to get the value into the realty companies. So according to me, it's a little premature to invest in them, but there will be a point at which the property prices will start moving, and then people will start buying into the realty companies. It's a good place to be. That's my personal feeling.
Pashupati, anything that's looking deep value at this point of time, or even short-term tactical opportunistic, if I can call it that? Anything in any of the sectors that's looking in that kind of a breadth?
Actually, you just need to buy a Make in India company that is not dependent on any imports and that there's a domestic demand from. There are a few in there. You can buy any of those, sit on them, and just enjoy the run. I mean, even sectors like paints, sectors like groceries, some of them may be a little bit high priced, but I think they're the place that you want to invest in because they're going to continue to do well.
Pashupati, give us the formula.
The formula? I wish I have a printing machine in my house. That's what I need. Anyway.
Yeah.
Thanks, guys.
No. Thank you, Pashupati. Thank you. Okay, Kunal, let me come to you. With regard to realty in particular, any favorites within that pack?
Yeah, I think now the opportunity is quite ripe for the real estate stocks because many of the stocks like Godrej Properties, Oberoi, Prestige, etc. These stocks have gone through a decent 5% to 10-ish% correction in the last 1 month, broadly 3 weeks approximately for the real estate names. Generally we say that a 10% correction to the stocks and the ones which have been performing is a good opportunity because when these stocks come back and correct by 10%, coincide with their 50-day moving averages. Like for example, the case was for Oberoi Realty. I think the stock made a high of 1940 thereabouts, and now it's sub the 1800 levels, 1790, 1780 thereabouts. So that completes a decent 10-ish% correction for the stock. It also coincides with the 50-day moving average. So I think when you see such kind of an opportunity, the trade setup starts to balance back again into these names where the stocks could probably come back into a recovery mode. And if that happens, you're looking at a swing trade of maybe 5% to 10% very quickly into many of these stocks. So Oberoi Realty, Godrej Properties, DLF, they remain to be top bets even at current levels.
And Kunal, Mr. Advani was highlighting how the tilt should be towards domestic-facing sectors, given that there is so much happening geopolitically. How are you looking at manufacturing, and particularly manufacturing of heavy machinery, precision engineering? Any broad themes within manufacturing that look good to you right now?
So I think the power manufacturers or the power ancillaries are the ones which are looking very attractive. We were discussing this, that for example, a stock like G1 TND, I think that's another name which has been doing fairly well. That's a stock which has corrected more than 15% in the past, say 1 month, 1.5 odd month, broadly from the June-July highs. So many of the stocks in the similar category are looking attractive. The idea over here is that there is a theme which the markets evolve or go into, but then the timing of these, the entry of these stocks is going to be very, very crucial. You don't want to start looking at timing these stocks at a point when the breakout is actually happening, and then these stocks immediately post the breakout go into a phase of price correction or a cool off just because of the mean reversion which is pending into these names. So I would suggest that it's better to try and buy these stocks at a point when the stocks go into a correction phase. I think power manufacturers or the equipment manufacturers are the ones which I would sense should be a good trade at the current levels.
Okay, that's the take coming in on some of the manufacturing names as well as power-related names and power anchors. But shifting focus then, let's take a look at the FNO snapshot this hour, and Sajid is joining us on the show with that. Sajid.
For that, the Nifty ending absolutely flat in today's trade. But what you see in the cash session is the open interest build-up of nearly 1% for the Nifty futures, and that Nifty futures is now trading at a premium of 76.3 to the spot, which is the 24,583, which is the settlement price at 330 there. Nifty Bank, again, we're seeing some shorts getting added there. The index ended up lower, but open interest up nearly 0.32%. And if you look at the constituents, you had public sector banks where we've seen in the where there's a lot of short position which is coming up in the constituents of Nifty Bank there. So that's one thing which you need to look at. As I said, SBI, Bank of India, Bank of Baroda, PNB, all seeing some kind of short position build up. There's a reversal that we saw in HDFC Bank. In the morning, we had some long position coming up, and now towards the end, as we go towards the end trade, there is a shorts which are getting built up for HDFC Bank in today's trade, with ICICI Bank and Axis looking at some long positions to close today. But the activity is in the call and put writing. We saw towards the second half a bit of put writing that came in, and as a result of which we tried moving towards 24,600, but we came off that. And if you look at the distribution chart, you'll see that 24,600 is holding on as of now, and with the good support coming at 24,500 for the Nifty. Among the gainers today, you have a lot of earnings-led companies, which are Hitachi, which is up nearly 11.3%. Paytm is up on the back of the Bernstein report, which upgraded the price to 2,200 rupees. MCX saw some long build-up happening, 4.35% up there. In the losers pack, you have Bharat Forge, where we have seen after the earnings that came in, little disappointing, some provisioning that also came in because of the losses which to one of the subsidiaries. The stock down nearly 7.62%. PFC is down 7.5%, and REC down 6.2% in today's trade there. But operators gainers include Amber, where the operators are nearly at 29%. Bharat Forge saw a late spike in open interest, with open interest jumping nearly 23%, and PFC is seeing open interest jump of nearly 19.7% in today's trade. In the losers pack, Keynes Tech, after the earnings which were disappointing, there's some long unwind that we saw. BSE is up on the back of short covering, anticipation of an possible inclusion to Nifty 50 that will come out towards the end of the day by the index committee, but that's where it is. But the Nifty, as I said, is absolutely flat at this point in time, and the Nifty futures at 24,660, trading at a 76 point premium to the spot.
Okay. All right. Thank you so much for that, Sajid. In fact, completely timed out on this edition of Closing Trades as we've closed in on the market. It's a thank you and a goodbye from all of us here in the studio. Kunal, thank you so much for joining us and giving us all of those views.